Welcome back, fail-safe investors. In today's episode, we're looking into a company that is in the financial sector, and we're going to look at it, how it operates, how it generates income, what it's looking into, what it benefits from, what trends are we looking at, and then we're going to look at the financial statements. I always preach financial statements, and hopefully I can give you the advice to make a fail-safe investment. And disclaimer, I am not a financial advisor. I'm just giving you my opinion on certain companies and analyzing stocks to make it easier for you to make a decision. Before we get started in today's video, I'm just going to give you a little bit of background on me. So my name's Terry. I'm from Chicago. Go Bulls, Bears, all the teams. But what pretty much got me interested in investing was I needed a vehicle to put my money in to pretty much grow wealth for my family. I don't come from much. I come from middle class to poor class. And I'm pretty much doing this for my future generations. I don't have any kids right now. I don't know what the future holds, but I do have nieces and nephews, and I want to be able to help them in the future also. So this is for my family, not just my immediate family, but everyone. And I consider everyone my family, that if I make an impact in your life, we're a family. We're in this together. So sit back, enjoy the episode, leave some comments, hit the subscribe button, hit the like button, and tell me what you think. Okay, so Discover, ticker symbol DFS, has a market cap of $11 billion. So that is a large market cap. That's not very large or mega. So that means it has a lot of room to grow. And that's what you're looking for when you're looking for growth companies. So I would consider this a growth company. Some people might say it's a value company, which means like you would hold on to it forever. But this company has a lot of growth potential. It has room to grow. So with that said, with a market cap of 11 billion and a price to earnings of, I think, 5, that means you're spending $5 for every dollar of earnings per share that this company brings in over this next year. So that is really good. That is a discount play right there. And with the earnings per share being $6.68 from 2019 and a current dividend yield of 4.86, you can't beat it. Like, they are still paying a dividend right now to this day. And when a lot of companies have cut their dividend, they still paying a dividend, and not to mention that their payout ratio for the dividend is only 25% of their total profits. So that is great. This is a solid, stable company if you're looking at buying them. This is definitely a company worth looking more into. Okay, so for those who don't know, Discover is a banking service. They are a bank, but they didn't start that way. Discover started out as a credit card service for Sears. So they were started by Sears, and then they spun off. I'm not exactly sure what year they spun off, but they spun off into their own banking service, which became Discover Financial Services. But 85% of their income or revenue still comes from their credit card service. So Discover in 2019 filed that they have $95 billion in loan receivables. And if you don't know what loan receivables are, loan receivables is pretty much a service that a person has done or a company has done for someone, and they have yet to receive their money. So in the credit card world, a loan receivable is pretty much someone swiped their credit card and they carry that balance on their credit card, to make it simple. How Discover gets paid is through 5 ways: through their credit card loan receivables, student loans, personal loans, the Post network, which I'll explain in a minute, and their banking service. Even though they have $56 billion in their banking service, they can use that, they can securitize that and sell it to a third party and use that money to invest in other things. They haven't done that so far, but they have that opportunity to raise capital. And since they are a bank, they have to follow the rules that were set in place by the Dodd-Frank during the Obama era, where banks had to put themselves in a position that if a recession was to come, they would still survive and America wouldn't have to bail them out again. Thanks, Obama. So Discover had $3.6 billion in charge-offs, or a provision in charge-offs, set aside just in case for a situation like now where the economy slows down and people might not be able to pay their credit card bills and all of that. I should also mention that with that $3.6 billion that they had set aside for charge-offs, they also have a liquidity portfolio with $16.6 billion in it, or $16.6 billion worth of assets or cash together that they can liquidate pretty much at the snap of a finger, and then their total contingent liquidity would be like 56 billion. So if they need to liquidate cash, they can liquidate up to $56 billion, which is a great thing. So they're nimble, they can pretty much move in and out of things. And that they were ready for a situation like a recession. Also, on January 1st, 2020, Discover announced that they were going to add 2.5 billion to that 3.6 billion for charge-offs, having a little over $6 billion for charge-off just in case, like I said, something happened unexplainable that will slow the economy down. Looks like they were looking forward into the future to me. But like I said, 85% of their income comes from their credit card. So that's 9.7 billion that they made from that. And then you have to factor in that they only employ 17,000 employees, and to pay their 17,000 employees cost them 1.7 billion for the whole year. So that's not bad. So exiting 2019 and going into 2020, Discover had $9.6 billion in cash on hand, and that doesn't include $3.6 billion that they had sitting aside for the charge-offs. So they was already in a good position coming into 2020 for anything that was going to happen in 2020. So in good economic conditions, this company was going to grow, and it was going to continue to grow like it already was, which is a good thing. Another thing to keep in mind is if you've pretty much been following any trends, I'm pretty sure you've noticed that everything is kind of moving into the digital currency, not cryptocurrency, digital currency. So that's like mobile payments, credit card, debit cards, pretty much things that you can use to pay for things without having to use cash. So that would pretty much help this company like Discover, since they already have credit cards and debit cards. The more that you use their credit cards and debit cards, the more money they make, because they make interest from those payments. So people that's paying for things with their phone or credit cards and debit cards, that's great for Discover, and that is the way of the future. That's what a lot of companies, or that's what a lot of people are starting to like move towards. That's like the trend right now. So Discover is expected to make more money from that, and that's how they are expected to grow.
Digital currency is the way of the future. It's only a matter of time before people stop accepting or spending cash.
We're sorry, we couldn't hear you. Can you repeat that? Digital currency is the way of the future. It's only a matter of time before people stop spending cash. But like I've mentioned before, they have something, they make money through their Post network. And their Post network is pretty much how like Visa charges for transaction fees. So their Post network operates kind of like that. So they have ATMs on their Post network, and they have point of sale systems. So if you've been in like a gas station or anywhere and you've seen Discover on the machine that you use to pay for things, that's pretty much they're charging a percentage. They're charging the merchant a percentage of that to use their network. They made 197 million just from their Post network transactions alone last year. That's 2 thumbs up. They also have a partnership with the NHL and the Big Ten. So if you go to those websites, you might receive a discount for using a Discover card on those websites. So that's another way that they can make money also. Discover's also set up to benefit from the innovation of other credit cards like Visa and MasterCard, who's teaming up to come up with a biometric credit card. So they will also benefit from that. With the biometric credit card, it's pretty much like a fingerprint reader on the credit card that as soon as you insert it, you don't need to type in your PIN. It's automatically approved through your fingerprint, and you can go. I should mention though, one of the biggest threats to a company like Discover would be cryptocurrency though, because cryptocurrency eliminates the use of actual bank and cash altogether. So if you can go somewhere to like a gas station and you can pay using cryptocurrency on your phone, then you might not need a debit card or a credit card. You can literally just pay with cryptocurrency. So you have to keep that in mind when you're looking into companies. Another thing to keep in mind when it comes to like big corporations and times like these or recession is you should note that most of these companies have a line of credit with some organization, bank, or something. So in Discover's case, they have a line of credit with the Federal Reserve of Philadelphia for $34 billion also. So they have a lot of capital that they can raise if need be. Now, as of December 31st, 2019, they haven't used any of their $34 billion, but just keep in mind that they can if they need to. Okay, so now that you know enough about the company, now it's time to get to my favorite part, the financial statements. So this is why it is very important to understand the company that you're looking into. So when you're looking into the balance sheets of banks, you have to understand that these companies deal in debt. So pretty much they borrow just as much money as they invest, if not all of the money they invest or loan out. So with Discover having 80% of his money, over 80% of his income coming from his credit card service, out of that 95 billion in loan receivables, about 70 something billion of that was just from the credit card portion. So when you're looking at the balance sheet of Discover, you'll see something like, okay, 93.5 or whatever billion in loan receivables, but then when you look at the liability side, 70 billion, a little over 70 billion of the current liabilities will show up as loans payable, because that's money that was borrowed from another source to lend out to the credit card person or to the credit card service, and then Discover pretty much gets the interest paid from that. Looking at the balance sheet is pretty simple once you understand that. So ending in 2019, Discover has 7.8 billion in cash and cash equivalents on hand at the end of 2019, and they had 93 billion, a little over 93 billion in loan receivables, and that's pretty much all of their current assets. So that's all of the assets that they have or can be liquidated in a year or less. So then when we move down to their current liabilities, their current debt is $5.2 billion. And then their current loans payable is a little over, well, not a little bit over $71 billion, or 71.9 to be exact. That's not a little over, but it is, depending on how you look at it. But yeah, the loans payable is $71.9 billion. So that's money that they borrowed that they haven't paid back yet, that is due within this year, but they're also expected to receive $93 billion back from their loans within this year. So you have to factor both of those in when you're looking at a company like this' balance sheet. So Discover has a total assets of 113.9 billion. And then when you weigh that out against their total liabilities of 102.1 billion, that's pretty good when you also consider that to pay off all of their employees only costs them $1.7 billion per year. So even if this company pretty much goes out of business due to something that they can't control, or business stops and they stop making a dollar right now, they still have enough money to liquidate, pay off all of their debt, and still have a little bit of profit to pretty much get a business going again. So you have to factor that with a company like this. They have room to grow. They are growing year over year when you look at their returns, and they have enough money left over on their balance sheet that even if business slows down in the current year or beyond, they can still pay down some of their debt slowly but surely, and they also can borrow. So that helps with a company like this. They have a good credit rating. Okay, moving on to the income statement. So the revenue generated from last year, they brought in $13.9 billion in revenue, and from that $13.9 billion in revenue, they had a net income of $2.9 billion. So they did have a profit, and they can reinvest. And also you have to consider, since it don't take much to pay off their employees, they have a lot of money to reinvest. But that's profit anyway. So that's money after they paid off their employees and everything. And also I should mention that they only operate out of 2 buildings, a call center and a headquarters. So this is a really good company. And so, as we continue these steps, we go to the cash flow statement. So like I've said before, you want to get the free cash flow when you're looking at the cash flow statement. There are other things in the cash flow statement that tells you where is money going, where money coming from, where is money spent. But me personally, I just like to get the cash flow statement. I like to get the cash flow, which is like money left over after you take the net income and subtract the capital expenditures. And so for a company like Discover, like I said before, the net income is 2.9 billion, but their capital expenditures is only 284 million. So when you subtract that, you're left with $2.6 billion of free cash flow. And you want to get that free cash flow number, because that's where your profit really is. That's it for today's episode. And again, if you haven't already subscribed, hit the subscribe button, hit the like button, leave a comment below of any videos you want me to like look into in the future. And give me any recommendations you have. Much love. Appreciate it. Let's get it. Let's do it.